following is a paid program. The opinions expressed are not necessarily those of WNBU and Interbanks Media. Welcome to All Things Money with David Blain, a thoughtful and revealing discussion of actionable ideas and effective strategies to help you through the complex world of investing, taxes, and real estate. Now, with All Things Money, here's David Blain.
Hello and good morning. This is David Blain coming to you today. I'm glad that you decided to join us. We got a great show lined up for you today. We're going to talk about annuities, a subject that normally you hear me jumping up and down and beating up on pretty good. I know that I was driving somewhere on Saturday morning. It was to soccer, taking my kids to a soccer game, and there was on the way to soccer at 8 o'clock in the morning, there was a show about annuities, an advisor trying to sell people annuities. And then on the way home, about 1:30 in the afternoon, when I finally finished with the games for the day, there was another financial show on the radio, another guy talking about selling annuities, and I'm sure in between there, hopefully my show came on. You got a little break from it, but for the most part, there's a ton of financial advisors out there that are selling annuities. And today, instead of just beating up on them pretty bad, I thought I would give you some information maybe to help you. You know, there's a saying that about life insurance that also applies to annuities that I've never heard anyone wake up in the morning and say, gee, you know, today's a great day to go buy an annuity. For the most part, I would say, 95% of the time, people are sold annuities. And, they're sold on the guarantee potential of them. And so I think it's important that people fully understand what they're getting into and make an informed decision whether this transfer of risk strategy makes sense. And that's exactly what an annuity is. It's a transfer of risk. Just like when you buy, it is an insurance product. And let me just say that, first of all, we don't sell annuities. We don't sell funds. We're a fee-only advisor. We don't sell any products, which we think is the best way to advise people. There are advisors that take commissions. Some of them are very good people, but we happen to take the line that people pay us a flat fee for advice, and we tell them what we think. So we don't sell annuities, so I don't really have any bias here. We're trying to give you the straight information. And so an annuity is an insurance product, and just like if you own a home and you cannot afford to rebuild that home if it burns down, you buy insurance. And the theory is that spread amongst a large number of people, you help transfer that risk to a lot of people. So if your house burns down, part of the premiums that your neighbors have paid goes to rebuild your house on the assumption that not everyone's house is going to burn down. So you're transferring that risk. The same thing takes place with auto insurance or even life insurance. That really what you're insuring against with life insurance is a premature death. Everybody, unlike your house, not everyone's house burns down, but everyone is going to die at some point. So in that particular case, you're transferring the risk that you die a premature death. Now, one thing with all insurance products or any business, for example, is that whatever the cost is, you have to assume that the company is making a profit on that, or they would not continue to sell it. So that's the first thing that you have to remember when buying an annuity is the company that's selling it is making a profit on it. And so, yes, you're transferring some of the risk, but is there another method that you could transfer it for lower cost? Now, the annuity, the insurers that issue the annuities, remember, there's nothing magical that they can invest in. They're going to go out and they're going to take your premiums and they're going to invest in the same thing that you and I have available to invest in. High quality bonds, stocks, derivatives, hedge funds, whatever they invest in, they're available to you. So that's kind of introduction here. We wanted to start off with annuities have a really bad reputation in the industry and a negative stigma, and I think it's deservedly earned. That being said, there's over $200 billion worth of annuities sold every year. and trillions of currently existing annuities out there. And with baby boomers continued to retire every year, and the market ups and downs still fresh in people's mind, this is a burgeoning industry. A lot of the annuity salespeople continue to hammer on the fear of people, of elderly people. You know, they try to scare them into they're going to run out of money, and you know the next bear market is around the corner and you're going to lose all your money again. And just, you know, a side note, if you had a diversified portfolio in the first place, you wouldn't have suffered that large of a decline, but that's for another show. So they're promoting this guaranteed aspects of it, the lifetime income, and granted, these are important. You certainly don't want to be investing in an annuity for the growth portion of it. There's way better ways to invest for growth. It's those guarantees that you're really purchasing. It's that transfer of risk for an annuity. Now remember, if you have Social Security or a pension, those are annuities. In fact, if you're a federal retiree, and I'm sure other local and state retirees, if you look at your pay stub at the end of the year, it says annuity on it. It is an annuity. So a lot of people already have an annuity in their portfolio. Social Security is an annuity. It is a stream of income that you cannot outlive. Now, it may not be enough to live on, but you cannot outlive Social Security. The majority of pensions out there, you cannot outlive them. So when you're looking at your overall picture, don't forget those guaranteed sources of income you have. And there's nothing wrong with having, you know, if you have Social Security or you have some sort of fixed income as a base, you know, layering on top more guarantees and more conservative investments is not necessarily a good thing. You know, I have a saying in life that, well, I have a lot of sayings. One of them is that security comes from opportunity, and I truly believe that. You look back at the communist and socialist nations, and all those people had job security. I mean, you know, they could not be fired. They were guaranteed a job in the old Soviet Union by the state. You know, it was guaranteed. They had no opportunity. They had an awful life. You know, that was one of my majors at West Point was International Affairs, specializing in Soviet studies. Those people had no opportunity. They had no life. They had all kinds of security. You know, they had, you know, a loaf of bread and you know, a thing of vodka was allocated to them, so that, you know, there was security there, but there was no opportunity. So whenever you're trading security or guaranteed, remember you're giving up some sort of opportunity, and make sure that that's a trade-off that you want to make. We're coming up to our first break here. When we come back, we'll continue talking about some of the costs of annuities and what to look out for.